So traders often get stuck in theory land. They always spend time studying smart money concepts, market structure theory, Elliott wave theory, the next new indicator theory. But what traders really need is not just more theory, not just more information. What counts in the market is application. And the exact checklist that I want to share with you is a 5-step checklist. And when all 5 steps align that I'm going to be sharing with you today, that's when you place the trade 10 out of 10 times, because it is a high quality, high probability, high win rate, and high risk to reward setup. Everything that you need to have conservative risk to make appropriate gains towards your trading goals. And the problem with those traders that religiously follow strategy, what do? They treat it like they're back in school and they just open up the textbook and they just read and learn. They watch all the YouTube videos, they watch all of the courses, and they spend weeks and months heavily backtesting, going through case studies, and they don't even make $1 in profit. Why? Because they were so focused on theory as opposed to application, implementation, and a step-by-step strategy, taking it from theory to actually a profitable approach. And why should you listen to me? Well, I've been trading for over 9 years now. I've made millions of dollars from the markets myself, and I've shown proof of my credibility through my public track records, through my public documentations, plus the additional components like a broker sync journal, a MyFX book, and also helping thousands of traders become funded and make life-changing money. And by the way, each one of these 5 points is not rocket science. You don't need to be obsessed with technical theory and things that overwhelm you, that overcomplicate things for you. And I'm pretty sure all 5 steps you already know about, you just didn't know how to connect them together. So the first step is understanding trend, direction, and points of interest. And I'm going to give you the exact criteria of each one of them. That's going to help us understand quality zones we should be paying attention to. So trend and direction is determined by new territory found in the market. For example, when we have this area that didn't break the previous low, that went on to make a new high in the market, and that new high in the market is higher than the previous one, we know we have found a bullish main push. When this area doesn't make a new low now, it stays within the range of the previous highs. This is how we establish a trading range. So when the market has made now a new high in the market, we now make a new trading range. And because we respected the previous trading range, this now becomes the new external low because we made a new higher high. So that's why we start to identify main pushes with its external ranges from higher low to higher high. Now we have formed this higher high in the market, and this area fails to make a low, it doesn't break the previous one, and this area goes on to make a higher high. So once this area makes a new higher high, that is the moment this becomes the new external range, and we have then concluded a new main push in the market. And that's how you're following external market structure, in this case on the daily time frame. Now when we have the new range from this previous low to this high, forming new territory and respecting previous lows, when this area now goes and breaches it, we now go and have a market structure shift, and we have a bearish impulse, red to show it's bearish. That's when we go from a bullish trend to a bearish trend, where we go from this high in the market to no longer respecting the previous higher low. We go on to new territory and make a lower low. So therefore, this became the high of that range, and this became the low of this new range, breaking previous lows. So we put that as a bearish break of structure now. It's no longer the range, it's now a break of structure point. And this becomes the high, and down here becomes the low. That becomes now our external range. When it comes to external ranges, you find the point of interest, decisional or extreme. We've made videos about that on the channel, so make sure you check those out about how to exactly qualify a point of interest. Some key pointers for now. Number one, it's a high in the market that makes a new low in a bearish supply zone. Then you zoom into that area and you find an imbalance. When I want to focus on the highest portion, where is my highest imbalance? The second candle, the high of that candle to the low of that candle, we have an imbalance based on this wick. From here to here, there is an imbalance where price never touched. So therefore, that will be the low of my supply zone. And then the high will be the absolute high in a bearish market, and in a bullish market, a demand area will be the absolute low. So now I've taken the high to the imbalance on the daily time frame. I have now found a daily point of interest. Again, we can take this way more advanced, which I normally do in my other case studies. But for this one, for this simplified checklist, we just need to plot the daily imbalance on our daily supply zone, on our daily trend. And that's it. You can do it within 1 minute. You can learn it within a couple of minutes. And this is how simple it is. Now, bonus point if you can find an inducement within. If you can see price consolidated for a bit, then shot high before going bearish, that is a positive sign that we had an inducement within the supply zone. So we know not only did it make a new lower low, it had an inducement within. And because we look for the imbalance portion right here, we know that there was a lot of sellers in this point. So we know that we are coming back to the zone where the sellers really took aggressive interest before the bearish reaction. And therefore, we pair everything together. We have supply zone that made a lower low. We have an inducement to control intent. And we have bearish imbalance to show us confirmed intent. So now we have found a quality zone. Now, when we focus on this, we can see that price did have a pullback. And we saw that price started to make internal higher highs, let's do this in blue, and internal higher lows that went on to make internal higher highs. Of course, there is substructure within these blue complex pullback lines. So we have retracement, not a bearish lower low. When price comes up here, we know that it didn't reach the supply zone. So we are still bullish inside the pullback, inside of our bearish range from the high to the low. So when this area fails to make a lower low, we know that we haven't found a new main push. We respected this. So we see the build up, we see the inducement, we see the mitigation. We know that we are completing the complex pullback and we make a new internal higher high inside this range. As long as we are inside the dotted lines of the main push that we found, the lower high that made a lower low, as long as we inside that, we know we are internal price action and overall trend is still bearish. Now, as we arrive to the point of interest that we marked, this is where I'm interested and this is where step 2 comes in. So step 2, we actually remain on the daily time frame to bring our analysis all the way through from higher time frame to lower time frame. Here, we are going to be focusing on exactly inducement and rejection within the supply zone we marked. What that looks like is if I can find a inducement of some sort on the daily time frame, in this case, it's going to be this previous touch of the supply zone that got swept. And more importantly, we didn't have a bearish reaction. So we can see we had internal higher high because as we lead into this zone and we mark out the structures, we say that we have this internal high because as we approach our daily zone, I read price action and I say, okay, we've had this internal higher high, internal higher low, internal higher high, internal higher low, internal higher high. So we are bullish coming into this and we haven't had a bearish rejection yet on the daily time frame. And we are still within the daily supply zone and there's all this room above that price could come into the daily supply zone. So if I still see we are finding bullish price action, I wait for the last high, the last impulse that arrived into our daily supply zone, now getting swept. We see just a wick rejection of the previous high and the fact that this did not make a lower low. If price went on to make a lower low, then things change and it won't be for this setup. When I zoom in and I know I'm on my daily time frame and I'm within my daily supply zone and I haven't had a bearish rejection yet, and I see that price now wicks through the previous high on the daily time frame within my supply zone, I mark that out and say potential inducement. We need to confirm it, but potential inducement. Now, the reason we say potential, because for all we know, price could still continue higher. We've been bullish for now. Price could still just do this and keep going higher into the supply zone before it reverses. So we don't want to sell too early if price could come higher. So how do we know price is ready to sell? Well, first step is, do we find the inducement? Sweeping previous high on a daily zone, daily swept. When we see this, after this sweep, we want to find a bearish or doji or indecision candle. In this case, we found a indecision bearish candle. Why is it indecision? Because we have a large wick to the high side, we have a large wick to the low. So what do? When I see that and spot that indecision candle, I mark the high of that candle and I mark the low of that candle. Now I've understood that I found a inducement within my supply zone, taking previous daily highs, still within my bearish supply zone. And once that inducement has happened, I see that price is now indecisive. It's not heavily bullish. I'm not seeing bullish candles. I'm not seeing bullish imbalances. I'm seeing confusion in the market. And as we know, my domino effect theory on the law of cause and effect. The law of cause and effect is like an elastic band. When you pull that elastic band back and you let go, the elastic band is not just going to drop. It's going to ping forward. And the same with price action. When you load the elastic band back, when you take liquidity, because we're in a supply zone, we're taking this liquidity sweep of a daily high, we have loaded that elastic band. So when we let go, what should price do? Price should then suddenly start to violently come lower. The law of the domino effects is once you see one inducement high, you need to see a second one, and then a third one, and a fourth one, and a fifth one. The dominoes fall in a specific direction. We will stop seeing bullish inducements and we will start to see bearish inducements. And that's how we know price is ready. So for now, step number 2 is very simple. Find an inducement on the daily time frame and then find an indecision candle on the daily time frame. That's going to be a out of place bearish candle or a doji candle or a indecision candle like this, which is basically large wicks either side showing confusion and lack of direction. Now, step number 3 might shock you, but we're going to go all the way from the daily time frame down to the 1 minute time frame. Yes, this is a specific checklist strategy that is simplified so you don't have to focus on all of the mess of every time frame, top-down analysis, and all these time frames that keep making you lose money. It's a checklist of a strategy with data behind it. So what we do is we go from daily all the way to the 1 minute time frame, which basically is a sin in trading for most people, but I'm going to explain to you why it makes complete sense. By the way, before I break down exactly why we do this, I'm a firm believer in systems and data, and therefore in my pursuit of data and checklists and simplification, I've developed many systems like this exact strategy, like the many strategies I've shared on this channel. Another thing that I developed was a risk management operating system powered by data and powered by AI, so that I don't need to think what should my risk be. And that's exactly what I've been using for a year and a half to have the profitability that I have. I'm going to give it away for free for everyone that watches this video. I don't need anything from you. You can use it for the rest of your life. All you need to do is click the link below this video and get it for free. So now that we're on the 1 minute time frame, let's just quickly glance at everything we've done so far. So first of all, this was the last higher low that made this higher high into the supply zone. Once price did that higher high, we confirmed it was an inducement based on the previous daily highs. And then what did it do in that supply zone? Gave a rejection, but didn't actually break structures yet. So we can still have room to go lower. But what we need to start to see is rejection. So we found the high and the low of the previous day, the indecision candle. And we know that the first domino has fallen, which was the inducement that we found in the daily time frame. Now that we have the highs and lows of previous day, we just wait for market to go to London Open. That's the step. Once price arrives to London Open, you ignore the noise. Now you can either just manually plot it like we did today of the high and low of previous day, or you just use this custom indicator that I made for myself to find these key things like high of previous day, low of previous day, all plotted. It tells me it's Monday. It tells me the Asia range, the high and low, the session open, Frankfurt Open, London Open, the key windows. Everything is plotted, so everything is done for me and easy for me, and I don't need to make so many decisions in a day. Now, when we have found that, I'm just going to wait now for price to either go low or go high. And because I am bearish, I want to look for price to take the highs. So I'm going to wait from London Open. At any point, I need to wait for price to induce the high, because we found the first domino, the first inducement. We found the indecision zone. Now I need to find that second domino, the second domino of the inducement, to continue that domino effect of inducement after inducement after inducement. So what do? We ignore the Asia high and Asia low. We ignore all the market structure points. We just play price action and wait for an inducement of the lines we've drawn. Again, this is not needed, but we can start to see already that price has taken this trend line liquidity, induced, given a bullish push. Then we've had this mini build up, minor inducement, bullish push. So this is giving me signs that price is ready to start attacking my high of previous day line, which is what I'm expecting. And then we can find opportunities to get into the sell. So price now has given that strong reaction. We see price took Asia range liquidity. We had price take this liquidity, but no bearish reaction. What does that mean? Buyers are in control, and we are hunting more liquidity, potentially the high of previous day. Now we shoot through high of previous day. Now that is step 2 complete. Then we get into step 3. Step 3 is waiting for a rejection. Waiting for a rejection, some sort of confirmation to show us that the sweep of previous day high is not just a higher high and we are still bullish. Rather, it's a confirmed rejection and we should actually start looking for sells. But we don't jump into sells. That's reckless. We don't predict the market. We react to what price is telling us. So we see a zone, we wait for confirmation. If it's reacting as we want, then we look to get in. So now that we've taken the appropriate level, we've taken the high of previous day, now I need to start to see rejections. So what does rejections look like? Rejections are going to look like the last bullish push that led the market to go and take the high of previous day, being fueled by this minor inducement that we just mentioned. Now we have a minor inducement that led to a higher high, and we've taken high of previous day liquidity. Now, as long as price doesn't come into my demand area of that minor inducement, I can now look for internal structure to look for bearish intent. So what is that going to look like? Well, let's draw it very simply. So in a bullish market, when price has gone up, how do you find internal structure? So if you wait for this, is that a bearish sign? Even though price went low, it doesn't mean it's a bearish sign, because this could just go on to make a higher high. So we need to wait for this area that has a pullback that didn't come into demand yet, or did not make a lower low yet, and then fails to make a higher high. If it makes a higher high, we are just bullish. So it fails to make a higher high, it doesn't break that level, fails to make a higher high, and then goes on to break this level and make a lower low. Once we have found that, we have found 2 legs of bearish structure. Now we are on. Now we can find a supply zone and we wait for price to respect it or induce it, and then we can sell towards our demand area target. So that's exactly what we're going to be doing. We're going to wait for seller's control and then wait for an entry. So seller's control is going to be that 2 legs. So let's play through. So this is a key tip. What I just mentioned is the preferred way to get in. You wait for 2 legs of structure. However, when price comes to the 50%, from the low to the high, the 50% line, now we're already crossing that premium discount question. So maybe the pullback could already be done and it could just be bullish impulse, bearish retracement to the 50% and continuation. So therefore, to combat that, I need to arrive to this supply zone, the extreme of it, and look for rejection. Look for an inducement. Look for something to tell me the sellers are in control. So now let's mark out this supply zone based on the last imbalance we can see. And now now we have found this inducement of high of previous day zone that gave a bearish reaction, came to the midline now. So the 2 legs of structure is still an option, but I like to do the 2 legs of structure before we arrive to the midline. But the point here is we still have a clear target of this demand area. So price, for example, could do bullish impulse, start the complex pullback, come here, respect, and then continue bearish all the way down to this demand area. Then once it arrives to this demand area, then it might go on to be bullish again and go like this and go higher high. But until then, we can still look for sells. And by the way, we still have targets. We still have Asia low targets. We still have the external range from low of previous day that we already mentioned. And when we remind ourselves where we are, we can see that after this daily supply zone inducement rejection, we can now potentially see all of this trend line liquidity get started. And because it's a daily supply zone, we can start to attack the previous structure point, the previous higher low that made this higher high. We can now attack Asia low, we can attack market structure, we can attack trend line, and we can attack previous higher low. So there's a lot of room left in this price action. So I just need to find a confirmed entry. So step number 3 was finding that rejection zone. We've identified it based on high of previous day inducements. We look for some rejection within this point of interest. Step number 4, now that we've identified the zone of interest on M1 on an intra-session level, that was the first domino, the inducement of the day. Now we need to confirm that it's a respected zone and actually find an entry to sell. So here, now that we find a refined zone should be 5 to 15 pips. Here it is around 6 pips, so this is absolutely perfect. Now that we've found the appropriate zone, we've refined it, we know it's an inducement. The next step is finding a confirmation on a lower time frame, ideally in a key window, but we give ourselves a bit of a buffer, plus or minus 1 hour. So here I want price to arrive to my refined zone as we approach the New York window, and I want price to come in and give me a lower time frame rejection. So for now, what can I see? Price is coming into my refined zone and it's coming in with a series of higher highs, higher lows, higher high, higher low, higher high, forming a higher low. So we haven't seen any bearish rejection yet. Now I see prices made a lower low. So now we have found a bullish market switch to a bearish market. And therefore I have now found a bearish impulse and a bearish zone. So now that I've found that bearish rejection, I've plot the higher low to higher high that made a lower low, and I make a bearish break of structure like so. Higher low that made a higher high into my refined zone. There was no imbalance above it. This was the highest imbalance. Price tapped in. It swept all of this liquidity here. It swept some liquidity, bullish price action into our refined zone, pip perfect precision, closing off that imbalance, closing off the supply zone, doing a bit of an inducement, and then rejecting, giving us a bearish impulse. Now we have found an execution point based on a lower time frame that is our M1 break of structure. So therefore now this is prime to take an entry. We put our stop loss on the highest imbalance, we cover the high. It's about a 2 pip stop loss. So what I'll do is inflate it a bit to 3. I give a little bit below and a little bit above just to factor in spread. I don't like 2 pip stop losses. 3 is my absolute lowest. And now I've taken a inducement zone that was a rejection. I have found the next domino after my inducement of high of previous day, following on from, let's remind ourselves where we are, just so we don't lose context. We are on a daily confirmed inducement supply level. As price arrived here, we had the previous highs on the daily time frame getting induced. So when we found that inducement, we started to see that we had all of this trendline liquidity, market structure points, and this previous higher low that made the higher high. If we are in a daily supply zone and we found the first rejection, we are just looking for the next inducement of control. When I come into a lower time frame, we plotted the high and low of previous day. We took the high of day liquidity in our supply zone. We found that inducement rejection, and then we are looking for the next domino, which is our M1 domino. So to summarize, we had a daily inducement in a daily POI. Then we had a high of previous day inducement. Then we had a M1 inducement and lower time frame confirmation. We're connecting the dots. This is enough for me to say I can justify an entry, and my break-even point is going to be on the M1 shift. So my break-even point is going to be here on my M1 shift. That's my break-even point. And as always, my rule for taking a partial is going to be at 1 to 3 risk to reward, you take a partial. For this strategy, you could take the full volume. Usually you could say at Asia low or 1 to 10, but in this case, you can actually target your low of previous day. So when we come onto this daily time frame, I'm just going to hide the mess. We see that this was the first inducement point, and then this was our high of previous day, low of previous day. So if we find an inducement of high of previous day, after an indecision candle, we need a bearish candle because it's a supply zone. So we know we can at least target this candle right here. And that's essentially what we're targeting. So now that we've figured out the entry and exactly how we're going to execute on this trade, step number 5, the last step, is having a target, which is basically what we just mentioned. Now that we found the daily supply zone with the daily inducement, then an indecision candle. After that indecision candle, we induce the high of that indecision candle, and now we have found a rejection. So we've connected all the dots. The last dot is having targets, and the targets are simply going to be your 1 to 3 risk reward. That is your first partial. Take 50% of your volume there. And then the next target would be all the way down here, which is that indecision candle, the low of previous day. So you're trading from high of previous day to low of previous day. You're trading the range of the previous day's candle. And in this case, it's quite large, but in this case, it can give you up to a 1 to 24 risk to reward trade because we are trading with a 3 pip stop loss all the way down to a 75 pip gain. So therefore, high risk to reward, high win rates because we're waiting for so many rejections, and a very simple checklist. We play through this price action, price taps in to our exact zone. We break even right here, and then partial 1 to 3 right here. So already we've locked in 50% of our volume at 1 to 3. Okay, so that's the goal. We have 50% volume at 1 to 3 risk to reward. So the first target is our 1 to 3 risk to reward. We take 50% volume to lock in 1.5%. That one is done. And then we wait for our next target. We zoom out and we allow price to do its thing. We're at break even. We're risk free. We've taken a partial and now nothing needs to be done. We just wait. So as I wait for this to play through, we just need to see sellers take control. First of all, we take off this previous zone. We see price started to hold this level, give a bit of rejection. Why? Because this was our previous demand area. Buyers are going to be loading up in this area. We see a bit of buyer's rejection, fails. Then price comes to our next inducement demand. This area led to this higher high. So now prices come to an inducement level that led to a higher high. Buyers might get interested. We need to read. Are buyers taking control? Strong rejection, but no follow through. It's just after that strong wick, bearish, 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 taking it out. Let's see if buyers now load up. No buyer's interest. You know why? Because when you have such significant liquidity, the elastic band is stretched. Once you let it go, price flings to the next target. And it may seem like, how can you get 1 to 25 risk reward in a single day? Well, it's very, very possible. It's very, very achievable. It's not every day. You have to wait for high quality setups with a lot of liquidity taken, but eventually price will go all the way to the low of previous day because that's what happens after an indecision candle. In a supply zone, indecision needs to bearish. So the minimum we can expect is price going to that. And there we go, like clockwork, low of previous day met. In a single day from high to low, we have taken a full trade pretty much. And when we look at the daily time frame, that's exactly what happened. We had, just hiding the drawing tools, we had an indecision zone from the high to the low. And now we had a bearish candle. And after that, we can expect bearish follow through like so, because it was a daily supply zone. Obviously, we don't have to catch the whole thing. I'm not necessarily a swing trader, but after indecision, we have bearish. And when we remind ourselves of the trade itself, we didn't have to catch the whole move. We just had to catch a meaningful portion. But realistically, if you are a swing trader, you could swing this on and on. I don't think that's the best approach. Lock in your profits, take high quality trades, and make sure you follow these checklists and the restrictions, because as I always say, a restricted trader is a profitable trader.